Are you wondering why Warren Buffett termed The Intelligent Investor by Benjamin Graham as the best book written on investing? Are you curious about the investing strategy of Benjamin Graham, which arguably has been one of the most successful in the last 100 years? Today we bring you some of the most important takeaways from The Intelligent Investor by Benjamin Graham. Before we move on, make sure you press the like and subscribe button so that you don't miss out on anything related to financial freedom or stock market investing. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Every value investor wants to make millions in the stock market. The only obstacle standing in their way is the uncertainty of Mr. Market. Benjamin Graham, popularly known as the father of value investing, wrote what some would say the greatest book on value investing. The impressive records of Graham and some of his disciples like Warren Buffett are impossible to ignore. Here are some of the most important takeaways. 1. Everything about Mr. Market. Let us just say that you own a part of a business that you paid $1,000 for. Now, every other day, a person known as Mr. Market comes to your residence to lecture you about how much your part in that business is worth. Furthermore, he offers to buy your share or offer you an additional one on that basis. History tells us that Mr. Market's opinion about how much your part of the business is worth is actually pure gibberish. For example, in the March of 2000, Mr. Market estimated the value of your share to be around $2,600, while in the ensuing year, he estimated the value of your share to be a mere $500. Even though the income of the company increased by 50% and the profit of the company increased by 20% during the same period. Now, should you let this guy decide what your $1,000 of interest in that business is worth? Absolutely not. One of Ben Graham's core principles is that a stock is not just a ticker symbol with a price tag on it. It is rather an ownership you acquire in that particular business. When you buy a stock, you're actually buying a small chunk of the company in consideration. And because Mr. Market is not always rational, the underlying value of the business can always vary from what Mr. Market is willing to pay for it. In fact, it is often overpriced or underpriced as Mr. Market easily becomes over-optimistic or conversely too pessimistic. So Graham advises you to only invest if you would feel too comfortable to hold the stock in the future without seeing the prices fluctuate that Mr. Market brings with him. For a value investor who knows how to control emotions and keep his head cool, Mr. Market presents a great opportunity to make money. As he doesn't force you to strike a deal with him, he merely presents you with an opportunity to do so. So you should be happy when he presents you with prices that are ridiculously high, and similarly, you should be happy to buy from him when he offers a bargain. We must also assume that when Ben Graham wrote this book, people were far less bombarded with news, forecasts, news, and so on than they are today. Back in the 1970s, Mr. Market arrived maybe once in a day with the newspaper in his hands. Conversely, today he wants to strike a deal with us every time we use our phone. Just because Mr. Market visits you more frequently than he did back in the 70s doesn't mean you have to insure business with him more than people used to back in the 1970s if it doesn't meet your standards. 2. How to invest as a defensive investor. According to Ben Graham, there are two types of investors. The first one is a defensive investor, while the second one is an enterprising investor. Now, it is important to take note that most people are suited best to defensive strategies, as the time they have for investing is limited. So the defensive investor should create a portfolio with a mixture of stocks and bonds. Let's say 50% each for stocks and bonds. You should also keep in view that the amount you're investing for each category depends on your life situation and the current difference in average yields of stocks and bonds. Graham also wants you to restore this value every now and then. For example, if the stocks are outnumbering the bonds by 60-40, then you should sell stocks and buy some bonds so that the balance is restored. Invest a fixed amount of money after regular intervals. For instance, straight after you get your salary. This is also known as the dollar cost averaging and will allow for a fair average price of stocks and bonds. It will also help in ensuring that you don't concentrate on buying at the wrong time. Now for the defensive investor, there are a total of 8 things to be kept in mind. First, diversification in the companies they invest in. Second, also make sure that you're not overexposed to a single industry. Third, the companies should be large. That also means they should generate more than $100 million in yearly sales. After inflation, this equals to $700 million in today's value. Fourth, go for the companies with current assets twice as big as their liabilities. Fifth, the company you're going for should have a dividend-paying history for at least 20 years. Sixth, it should also not have any earnings deficit in the last 10 years. It should also be performing as well as more than 305 growth in earnings in the preceding years. Seventh, you should also not overpay for assets. That means the price of the stocks should not be more than 1.5 times its net asset value. 8. Don't overpay for earnings either. Don't let the PE ratio be more than 15 when using the last 12 months' earnings. 3. How to invest as an enterprising investor. So it seems like it would be so easy for all these defensive investors to beat the market. You just devote a little more time to investing than these average investors do, right? Unfortunately not. To be an enterprising investor and to beat the market is much more demanding as such a logic suggests. It basically requires patience, discipline, eagerness, and a lot of time. Safe to say, many professionals and private investors are not suited to this alike, as it is a lot easier to fall victim to Mr. Market and his price quotations. To put it simply, since the profits these companies are willing to provide the intelligent investor are going to be finite, the price therefore must also be finite. Price is probably the most important factor for the enterprising investor. Just like the market sometimes overvalued certain companies when they have been growing fast or are glamorous for some other reason, it tends to undervalue the other ones. Therefore, the intelligent investor should always try to ignore these so-called growth stocks. Why? Because the investments are based on future earnings, and the future earnings are less reliable than current valuations. 4. Insist on a margin of safety. There's one risk that no careful consideration can truly eliminate, and that is the risk of being wrong. But what you can do is minimize this risk, and this minimization depends on the margin of safety. As looked at earlier, the price and the value of the company cannot always be the same. When the price is at most 2/3 of its calculated value, the investor has found a company with appropriate margin of safety. For example, if there's a bridge which says the maximum load-bearing capacity is 10,000 pounds and your vehicle weighs somewhere close to 9,800 pounds, you wouldn't dare to take the risk. The same goes for investing in stocks. You should not invest in a stock with a price tag of $10,000 thinking that it'll be worth $11,000 in the future. The intelligent investor should never make a call that endangers its safety. A formula used in the book can give you some idea about the margin of safety. According to the formula, value equals current earnings times 8.5 plus 2 times expected annual growth rate. The growth rate should be equal to the expected yearly growth rate of earnings for the next 7 to 10 years. Let us assume the 3 largest companies from the S&P 500 that are Amazon, Apple, and Microsoft. We can use the formula to see how much these companies are worth. We can also use this formula backwards to see how much these companies were valued in the years before. 5. Risk and reward are not always correlated. When we talk about theory, it suggests that the returns an investor should be hoping for should be proportional to the risk he is willing to undertake. Risk then is calculated as the volatility of the returns of investment, meaning how much the stock value has differed in the past. But Graham does not agree with this statement. Instead, he often argues that the price and value of assets are often disconnected. Therefore, the return an investor can invest depends on how much time and effort he brings in his bargain of assets. So risk and reward are not always correlated. Most of the value investors overlook these principles and get themselves in a state of wobble. For that purpose, we've provided you with a free ebook in the description below, which focuses on the 6 different stock categories that are important for every value investor to analyze. So what is your favorite takeaway from this book? Are you employing these key points in your investing strategy? Let us know in the comments section below. Subscribe and turn on notifications. Check out this video we handpicked for you, and we'll see you in the next one.